My view on all of this is that 2020, obviously the world had shut down. I remember you and I speaking just before it happened. And what happened is the global economy stopped entirely. And to stimulate it, as everybody was at home, they both undertook massive amounts of quantitative easing, but also they did something different, which was fiscal stimulus, direct handouts. So as we started pulling through the business cycle, as the world started reopening, then the inflation genie that comes from fiscal stimulus, which is very common, not from monetary stimulus, we'll come on to that later, that started appearing in the global economy, and the central banks started to hike rates. They started late. They didn't think it was going to come as big as it was. Then Russia invaded Ukraine, and obviously all commodity prices go through the roof, supply chains get shattered, and that exacerbated the existing supply chains because people weren't back in the workforce, all of that stuff, factories weren't ready. So we start with this big inflationary pressure. So the Federal Reserve then decide to hike rates at the fastest rate of change in all recorded history. And eventually that tends to lead to the kind of negative side of the business cycle. So that starts playing out. The forward-looking indicators start falling, suggesting we're going to go into recession, which everyone's been talking about. And a lot of people have been saying, well, what's going to break? If you raise rates this much, something's going to break. And eventually it was the banking system. And it's all a story, as ever, of too much leverage.
The recent bank failures in the U.S. have exposed the fractional reserve banking system's core limitations and strengthened the case for investing in Bitcoin, BTC. Analysis by crypto services provider Matrixport shows that American buyers are leading the safe haven bid for the cryptocurrency. Bitcoin has rallied by over 40% in 10 days, reaching a 9-month high above $28,000. Hello and welcome to Money Talks. In today's video, Real Vision CEO Raoul updates about his outlook for blockchain technology in 2023. Raoul also breaks down the reason for the banking crisis and what's going to happen in the next few days.
I don't think they're Machiavellian in we're going to break something. What they're trying to do is slow the business cycle down because that's how you get rid of inflation. Now, always at the bottom of every business cycle, whether it was 1990, 2000, 2001, 2008, 2020, always something breaks because of rates and a slowing economy. So that's just a function of what happens in a business cycle, much like there's a boom at the peak of the business cycle and usually kind of excess leverage and excess optimism. So I don't think they tried to break it. Now, it's coming out that, obviously the Fed kind of knew that the regional banks weren't great. We also know the pension system's a problem. We also know there's a number of things that can be a problem in this system when you've got a globally indebted situation like we've got today. The world has never been this far in debt, and no country in world history has ever been as far in debt as the US is as a percent of GDP. So it's problematic, but that's just a function of the business cycle.
Bitcoin is available to trade 24/7 worldwide. However, price action varies through each 24-hour cycle depending on the news flow and macroeconomic data releases. Of late, the news flow has been dominated by banking sector issues in the U.S. and the resulting repricing of interest rate expectations lower. That explains Bitcoin's positive performance during U.S. trading hours. American hours have been a major source of bullish pressure since the beginning of the year, according to Matrixport. Bitcoin, BTC, is up plus 66% year-to-date, and during U.S. trading hours, Bitcoin rallied 47%, while the cryptocurrency only rallied by plus 16% during trading hours in Asia. Bitcoin has barely broken a sweat during European trading hours, just plus 3%.
So there's two levels for what a bank is. It is the deposits that they have, that's what makes them a bank, and then it's what they do with the deposits, they invest them. So in a normal course of events, banks make business by something called the steep yield curve. So they borrow at, let's say, 2% interest rates, i.e. they pay you 2% on your deposit, and they lend it out to the market at 5%. That's the yield curve. So that's a longer term duration that they take the risk on. The issue is the yield curve got massively negative. In fact, the second most negative yield curve since 1980. So that means that the banks ordinarily would have to pay you 5% or 4% interest on your deposit, but then they invest it in the bond market in 20-year bonds or 10-year bonds or 30-year bonds, and they're actually getting less money. So they're losing money every day. So what they did is artificially change the yield curve. So they said, well, we're actually going to give you 0.5% interest on your money, and then we can lend it out in the bond market at something different, at a higher rate. So they manufactured a steeper yield curve. The issue is people have the freedom to move their deposits. So they can move their deposits out of this 0.5% world into a 5% world of CDs, Treasury Direct, money market funds. So people are incentivized to move their deposits because the rate of interest is actually the highest we've seen for a long time. So people are incentivized to do that. That means deposits shrink from the system. As they shrink, you have to unwind the bets that you had at the long end, the longer maturity bets. Now, the problem is those are all underwater because the Fed raised rates so much. So then they've got losses, mark-to-market losses. But to collapse the deposit base, you have to realize those losses. Normally, you can just leave them on your book as mark-to-market accounting. You don't need to worry about it. But in this case, you have to do something about it. Suddenly, poof, they're all got no money. So that's the real issue here. Now, there is a big shit fight going on about what people should do about it, what the government should do about it, what the Federal Reserve should do about it. People say, well, if people are getting scared now because they saw Silicon Valley Bank and Signature Bank go under, well, we should just guarantee deposits in the system. Okay, sounds great. Problem is, it doesn't get rid of the actual issue. The actual issue is the rates are too damn high. So the banks can't make any money. So if they just guarantee the deposits, people still go to Treasury Direct and get their 4.5% or 5% yields. So it doesn't stop it, slows it down somewhat, but it's still a huge problem. The only answer here, the only answer that they have is to massively cut rates, and I think 300 basis points plus, and also undertake QE. The reason they have to undertake QE is the banks, particularly these regional banks, smaller and medium-sized banks, have another big issue on their balance sheet, and that is they are the largest lenders to the commercial real estate market. Now, if we go back to when we first spoke at the beginning of the pandemic, at that point, we were all going to the office. I was in New York when I saw you because I was going to the office and we had 60 odd people in our office at Real Vision. Now we've got 3 people in our office. We've downsized once and we still only have 3 people in the office and we can't get out of our damn lease. And everybody's got the same issue. Nobody's going back to the office. The world has changed. We can all work remotely. So we used to do interviews like this in person. Now we do them over Zoom. So then we've got massive amounts of commercial real estate that are basically empty. And the numbers are a bit weird because you also need to realize that empty office space that's registered is entirely empty. But actually, most people are trapped into leases where they've got 10% of their workforce going in. So as soon as those leases come up, people are going to tip those out too. So we've got a second bomb to hit these smaller banks, and that is this real estate market. And the real estate market is going to be illiquid, and chances are it's not going to get solved. I mean, I spoke to one of the biggest managers of commercial real estate for one of the biggest pension funds in the United States, and he's like, they're going to bulldoze over this stuff in the end because people are never going to use this. Yes, we can repurpose some of it for residential property, but actually it's quite difficult from regulatory reasons and how you fit plumbing and all sorts of weird stuff. So he said, look, we can repurpose some of this stuff, but a lot of this stuff is just going to get bulldozed into the ground in the end. And that's in 10 years' time because there's nobody going to use that real estate. So somebody has to pay that. Now, that would ordinarily mean this is like the savings and loans crisis in the 1980s and 90s. It drags on and on and on. But we've changed the game here because we know the answer. The answer is what Mario Draghi did in Europe in 2013-12. And I saw this firsthand. I was living in Spain. What Draghi did is say, we'll take all of the shit on your balance sheet. We don't care what it is, screwed up bits of paper, anything. We'll just lend against it. to keep the banking system insolvent and then slow manage the decline of the banking system. That's the position we're going to have to be in. These small to regional banks will never recover regardless because they've got too much commercial real estate. Not all of them have, but the vast majority have. And then they've got the problem with the current problem, which is the deposits are leaving the system and their investments are underwater. So it's a big mess. So the short-term issue needs to get solved by cutting rates really fast, not backstopping deposits, doesn't help. And then we've got the bigger problem is what the hell do you do with all this junk on their balance sheets? And we know the answer. It was invented in 2008. Well, actually came out of Japan beforehand, is the central bank will put it on their balance sheet in the end.
So, what are your thoughts about Raoul Pal's explanation of the banking crisis? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.